Hello everyone, myself Vasanthi, Assistant Professor, Department of Commerce from St. Josephs College of Arts and Science for Women, Hosur. Today's topic is capital gain or loss. So what is capital gain? So capital gain refers here increasing the value of the capital assets when it is sold. So in simple words, capital gain when you sell an assets for more than what you originally paid. So capital gain are realized when you sell your assets by less than the original purchase price from the sales price. So definition of the capital gain. So profit one is earned on the sale on the assets like stock, bond, real estate. In the result of capital gain, the selling price of the assets exceeds the purchase price. So it will be difference between the selling price and cost price. If selling price is higher, the cost price is lower means then only your assets will be getting a capital gain. So in case your cost price is higher, your selling price is low means so it will be a capital loss. So definition of capital gain and capital loss. So capital gain means the profit one is earned on the sale of the assets. So capital gain, the selling price has to be exceed the purchase price. So capital loss means it will be the cost price will be higher than the selling price. So who is liable to pay the capital gain? The soul of the asset, it will be come under the category of the capital asset. So if you have profited from the sales, it will be liable to pay a tax. The sale is made in the previous year, so immediately before the assessment year, they have to be liable to pay the capital gain tax. So what is mean by capital assets? So capital asset means a kind of property so which is held by an assessee. So whether it may connected with the business or profession of the assessee. So any securities will be held by the FII that will be invested as a securities. It will be regulation under the SEBI Act 1922. So these types of securities called as a capital asset. So any ULP will be exempted under the section. So do not apply any account of the applicable for the provisions thereof. So next one is types of capital assets. There will be two types of capital assets. One is short term, another one is long term capital assets. So short term capital assets which is held by the taxpayer for not more than 36 months. They have to be immediately preceding the date of its transfer will be treated as a short term capital assets. For listed securities, the short-term capital assets is less than or equal to 12 months. For unlisted shares, the short-term capital assets is less than 24 months. So any other capital assets not mentioned in the above two, listed and unlisted, the short-term capital assets is less than equal to 36 months. So next one is long-term capital assets. So which the asset is held by the taxpayer for a period more than the 36 months. They have to be immediately preceding the date of the transfer will be treated as a long-term capital assets. So for equity or UTI or zero coupon bond means it will be more than 12 months. Any land or buildings, it will be a more than 24 months. Any other capital assets is more than 36 months. Types of capital gain, short-term capital gain, then long-term capital gain. So short-term capital gain means the asset which is sold within the 36 month of the acquisition. The profit earned for is known about the short-term capital gain. So for example, if the property is sold within the 27 months of purchase, it is called as a short-term capital gain. So next is long-term capital gain. So it's the profit earned by the taxpayer and assets that is holding more than the 36 months means they are known as the long-term capital gain. So after 31st March 2017, so holding a period non-movable property was changed to 24 months. So however, it is not applicable in case of movable assets such as jewelry, debit-oriented mutual funds. So how to calculate the capital gain in India? So first one is, so we have to be sale value consideration after deducting any expenditure incurred during the transfer of the property, like any expenses incurred on the sales. So after we have to be deduct the cost of acquisition. So after we deducting the cost of improvements. So finally we have to be getting the exemption section 54B, 54D, 54G and 54GA. So balancing amount is called as a short-term capital gain. So these are the format while computing the short-term capital gain. So how to compute the long-term capital gain? Same full value considerations, and then we have to deducting any expenses incurred in the connection of the sales. So next we have to be deduct the indexed cost of acquisition less indexed cost of improvements. Finally, so we have to deducting the exemption section provided by the section 54, 54B, 54D, 54EC, 54EE, 54F, 54G, 54GA and 54GB. So finally we are getting the balance amount of long-term capital gain. So these are the format we are computing a long-term capital gain. So thank you.